Okay. Good evening, everyone. Nice having you on this platform once again. Without wasting our time any further, you can see that we are 5 minutes behind schedule, not because I came on board late, but because I noticed there are few number of students than necessary on the platform. Hence, I needed to give some time to make sure that at least we have a reasonable number of students before the class commences. Okay. Now, our class rules and regulations still remain. I believe by now you should be familiar with those rules and regulations. So, needless for me to start going through them again so that we don't waste precious time. So we straight away go to the business of today. Yesterday, we were able to was the question number 1, yeah. It's 1, which is a KPSA, which is of capital. And we look at the NPV, the cost of computation, that is a project specific cost of capital, which is requirement A. We're also able to evaluate the project by computing its NPV. Then we are to see any 3 assumptions related to our computation of the NPV and the cost of capital. Okay. Ahmed Munir, you don't need to raise your hand. If you have a question, use the chat button. Use the chat button. Please, you don't need to raise your hand when you have a question to ask. Okay, before I go to requirement 3, after the class yesterday, I got some calls from students on the treatment of capital allowance. And I promised that today I was going to address that so that you know how you should treat your capital allowance. The first question I got was that in some questions, you will see that capital allowance will start from year 0. In some question, capital allowance will start from year 1. So there is a confusion as to when do we need to actually start charging our capital allowance. To remove that problem, you have to pay attention to the question. For instance, let me use this project as an example. The first one here is my year 0. If an asset is purchased in year 0, an asset is purchased in year 0, and the examiner lets you know that capital allowance is charged as soon as the asset is purchased. Then, since the asset is purchased in year 0, obviously, my capital allowance should start in year 0. If you are doing tax saving on capital allowance and tax is paid a year in arrears, it means that the capital allowance in year 0, the tax savings will occur when? In year 1. That is why you see in some question, the tax saving on capital allowance will be charged from year one. The assumption the examiner is making in that regard is the fact that the capital allowance is charged as soon as that asset is purchased. And because tax is paid a year in arrears, the capital allowance will be enjoyed the following year. I believe that is clear. That is number one. Secondly, the question can tell you that capital allowance is charged in year one. That you start computing your capital allowance in year one. If that is the case, capital allowance, you start to charge it from year one because that is the requirement of the question. And if tax is paid a year in arrears, it means that the capital allowance in year one, the tax savings will occur when? In year two. Okay? Now, what about a situation where the question did not give you any direction? You are not told whether capital allowance will be charged in year zero, neither were you told whether capital allowance should be charged in year one. In that case, the examiner has left you to make your own assumption. The examiner has left you to make your own assumption. You can assume capital allowance is paid as soon as the asset is purchased, that is the year the asset is purchased, or capital allowance will start in year one. I will advise, if this situation arises, always assume that capital allowance is charged in year one, so that if tax is paid in arrears, the tax savings will occur in year two. I believe I've made myself clear. So that should not create a problem for you any longer. The second question I got was still also on capital allowance. The caller asked a question as to the fact that in international investment decision, she has seen that what the examiner do, what they normally do is that they charge capital allowance as a whole instead of doing tax saving or capital allowance. There are two ways you can charge your capital allowance normally. It's either you deduct the capital allowance before arriving at your taxable profit, or you get your taxable profit, you get your tax, then you not do tax saving or capital allowance. However, when you are doing international investment appraisal, you cannot do tax saved on capital allowance, okay? You cannot do tax saved capital. What you can do, you have to charge the capital allowance to reduce the profit. And after you have computed your profit, you need to add back the capital allowance because capital allowance is a non-cash item. And for computation of NPV, the items you need must be items that are cash in nature. All right. So these were the two questions I got yesterday, and I needed to quickly bring it to the attention of everybody here in case of similar occurrence in your exam. Now we have to state three assumptions relevant to this question, to our solution. Assumptions are right there in the question. Number one that I'm going to give is the fact that normally in the computation of your beta of equity or beta of asset, you need what? Beta of debt, isn't it? Now, in a question where the beta of debt is not given to you, your assumption should be that beta of debt is zero. If beta of debt is zero, it means we're going to use zero to represent that beta in the formula. So in this question, we're not given beta of debt. Therefore, my assumption that I am going to make here is the fact that it is assumed that debt is risk-free with a beta of zero. You can see that I did not manufacture that assumption. The assumption is right there for me in the question. I did not manufacture it anyway. Assumption two, it is assumed that cash flow occurs at the end of the year, except for working capital and initial investment. Or normally, in your project evaluation, the cash flows are expected to occur at the end of the year. That is the general assumption, except for working capital. Working capital will occur in year 0. Okay, for year 1. Year 1 working capital will be in year 0. Year 2 will be in year 1. So working capital is assumed to occur at the beginning of the year. And initial investment also, if the question did not explicitly stated it, then it is assumed that it will be a year 0 cash flow. Are we together? So apart from these two cash flows, there are no any other cash flows that occurs in year at the beginning of the year. All other cash flow are assumed to occur at the end of the year. And that forms my relevant assumption number 2. Number 3, the patent and market survey are sunk costs. True or false? They are sunk costs. They are sunk costs. Sunk costs means cost that has already been incurred. And the decision as whether to continue with the project or not cannot change that cash flow because it has already been incurred. That is obviously a sunk cost. And number 4, the book value of the bank loan is same as its market value. That is another relevant assumption to our computation. I told you for non-traded debt, the market value is the same thing as the book value. And that is the assumption we have to use in the computation of our cost of capital. So just pick 3 out of these 4 and you are good to go. These are relevant assumptions. These are relevant assumptions. Okay. Let us go to example 2. Let us quickly go to example 2. As usual, what do we need to do? We need to go and read the requirement. What is the requirement of this question? Required. Calculate a WACC for PPT using TT beta. Calculate a WACC for PPT using TT beta. That is the requirement. So calculate WACC for PPT using TT beta. I don't need to tell you here that from this requirement, I can see clearly that my TT here is representing my proxy company, while PPT is my company whose cost of capital I am trying to compute. Now, I can go and read the question as a whole, paying attention to what I need, the information I need to be able to compute cost of capital. Okay. PPT is a private manufacturing company. The company holds patent for certain luxury skin care products, which it manufactures and sells to the wholesale market. It is also actively involved in research and development, R&D of new projects. PPT has a pre-tax cost of debt of 3%. So on that paragraph, put cost of debt. And gearing, debt to equity, solid debt over debt plus equity of what? Of 40%, based on its best estimate of the market value of debt and equity. So I can see the gearing of PPT on that same paragraph. So cost of debt and gearing can be clearly seen in the first paragraph. PPT is currently considering a number of different possible investment projects proposed by the R&D manufacturing department. When evaluating proposed investment, PPT has previously always used a discount rate of 10% to discount expected future cash flows. Now, let me explain the situation to you here. This question is not a diversification question. What do I mean by that? PPT is not undertaking a new project in another industry. No, this is not the situation in this question. The situation here is the fact that PPT in the past, always evaluate investment project using 10% as its own hurdle rate, meaning that the cost of capital of PPT was chosen arbitrarily. There is no basis. That 10% was not computed. It was assumed, okay? That was the practice prior to this time, okay? What now happened after then? However, the new finance director, FD, has challenged this and has suggested that the company should derive a WACC using the capital asset pricing model, CAPM. Consider that. When the finance director came on board, he said, no, why will you choose your cost of capital arbitrarily? It is not done. Let us have a basis for our cost of capital. He suggested that the company compute the cost of capital based on CAPM. Now, let me tell you this. When we say compute cost of capital using CAPM, what we are telling you to do is that the cost of equity that you will use in the what? In the computation of the WACC, compute it using CAPM. And for you to do that, don't you need better? Of course, you need better. So that's what this question is trying to say. Okay. This WACC could then be used as the discount rate in future investment appraiser decision. The managing directors, MD, has asked the FD to justify this proposal and to calculate a more appropriate WACC for PPT. I believe you are getting this. That is the background information as to the reason why we are computing our cost of capital for PPT. Okay. The FD of PPT has identified a company, TT, which operates in the same industry. So you can see that TT has an equity beta of 2.4 and gearing debt over debt plus equity of 30% based on market value. What are we saying here? Question is telling you that the finance director has now identified a company. This company is in the same industry with PPT. The company is doing the right thing because the company is having better. So the company has computed its own WACC based on the CAPM. That is why the company is having better. So because of that, we can say TT is our proxy company. Okay? TT, in this regard, will represent our proxy company. Okay. Additional information for TT now, okay, or even for both companies rather. The long-term market risk premium can be assumed to be 4%. The risk-free rate is 1%. Corporate income tax is charged at 35%. Debt beta for both PPT and TT can be assumed to be 0. Calculate a WACC for PPT using TT beta. So what do I need to do here? I will choose TT as my proxy company. I will identify the proxy beta, which is what? 2.4. Then I will ungear, because if you look at this, TT is having gearing, isn't it? The gearing ratio of TT is 30%. What does that mean? It means that TT is a geared company. And the moment it's a geared company, then the beta is geared. And even the question has even told you that this is an equity beta. Equity beta is a geared beta already. So what do I need to do? I need to ungear this beta to get my asset beta. Asset beta will now represent the market risk, the business risk that both TT and PPT are facing in that industry where they are operating. Okay, for me to ungear, you already know the formula. Beta of asset is equal to beta of equity plus, times market value of equity over market value of equity plus market value of debt plus beta of debt times market value of debt 1 minus the tax rate, all the value of equity plus value of debt 1 minus tax rate. Okay, that is the formula for ungearing. After ungearing, what do you now do? Well, after ungearing, you get your asset beta. After got your asset beta, because PPT is also GL, then I need to recognize PPT financial risk. That will take me to what? To rejecting the asset beta. So when I reject asset beta, I will get a beta that is specific to what? To PPT. Then I use this to compute my cost of equity using the CAPM. After that, I go straight. I've already been given my cost of debt, 3% pre-tax. I go and compute my WACC. And that will be all. So let us go straight and treat this question. Let us go straight and treat this question. Okay. My proxy company, where are you? That is TT. My proxy beta, where are you? You are 2.4. Okay, I ungear it. The procedure I gave you, this is the ungearing formula. And when you slot in, your market value of equity is 70. Okay, let me give you how to quickly compute the market value of, so to get the market value of equity and debt when you are given a ratio. Let me quickly stop sharing this screen because this is very important. I know most of us know it, but some of us do not know it. And I need to clear that immediately. Let me quickly stop sharing this, share my Excel file so that you can see what you are expected to do. Okay. So I'm sharing my screen now so that you can all see how to determine market value of equity and market value of debt when gearing is given. When gearing is given. Okay. Try to explain an Excel file, Excel sheet rather. Okay. Bam. Okay. Now, gearing is computed in either of two ways. Gearing, for you to compute gearing, these are the two relevant formula you can use either of them. Gearing is either you are computing it based on your gearing is equal to debt. Sorry, I put it here. Is equal to, yeah. Okay, don't worry. I'm going to adjust it here. Gearing is equal to, now, debt over equity. That is formula 1 of computing gearing. You can also say your gearing is equal to debt all over debt plus equity. I want you to get this once and for all so that it will not create issue for you when we get inside the question. Okay. Now, for TT, we're told that the gearing is what? The gearing is 30%. The gearing is 30%. For TT, the gearing is 30%. I believe you can see my screen, right? Let me see. Can you see my screen? Can you see my Excel sheet? You cannot. Are we all asleep on this platform tonight? Are we asleep? All right, thank you. Thank you. Now, whichever way you want to compute your formula, sorry, your journey, the question will give you a direction. Like for TT, this is what the question gave us. Debt over debt plus equity. That is what the question gave us as the basis of computing our work. Now, we're told that our debt over equity plus debt is what? Is 30%, right? Now, the interpretation of this is that debt The interpretation of this is that your debt is 30%. Okay? Your debt is 30%. Now, the rule is that the denominator here is what? Equity, debt plus equity, Abi. The rule is that the sum of the denominator must be 100, okay? The sum of the denominator must be 100. So, if my denominator comprises debt and equity, and debt is 30, obviously, my equity will be what? My equity will be 70. And the total will now be what? The total will now be 100. That is for the first one. Okay? That's for the first one. That's for the first one. I believe that is clear. Now, for the second one, you are told that your debt is 30. Okay, debt is 30. Debt 30. Okay, now the same rule. The rule is that, look at it, this is where I am now. This is where I am now. If debt is 30, and the rule is that the denominator must be what? Must be 100. And if you look at the denominator, the only item making up the denominator is what? Is equity. So obviously, my equity is going to be what? My equity is going to be 100. My equity is going to be 100. So my total capital will now be what? My total should now be 130. Equity plus debt. This is the difference between the first one and the second one. Okay? So the question will give you a direction. If you can say debt over debt plus equity, then you should come here. If you can say debt over equity, you should come here. That is the way you can interpret this. Okay? That's the way you can interpret that. So I'm going to stop sharing this screen now so that we go back to our normal slide. Okay? All right. So that is why I have my 70 as equity and my debt is 30. Tax rate is 35%. So I say better of asset, 2.4 over 70 plus 30, 1 minus tax rate plus is 0. You can see. I only put this so that I want to confirm to you that when debt beta is not given, I assume it is 0. The second part of the formula will always be 0. So that is why we don't bother. If debt beta is 0, we don't bother including the right hand side of the formula. Okay. So when you put this one here, we have this. Then we have 2.4 70 over 89.5. So that is giving us what? 1.88. That is giving us 1.88. Okay. Now, I haven't got 1.88. It means that is what? That is the business risk in that industry. What will I now do? I need to reject it by recognizing PPT gearing. And what is PPT gearing? PPT gearing, we're told, is going to be, it should be what? It should be 40-60. Debt over debt plus equity. Now, I need to reject this. This is my regearing formula. Okay? Just picture this formula. Don't cram. It's already there in the formula sheet. Know how to apply it. So I have my beta of equity equal to 1.88 plus 1.88 minus 0, 40 into bracket 1 minus 0.35 over 60. So when you evaluate that, you have 2.69 as the beta of equity that is supposed to be the normal beta of equity for PPT. Now, I will use that beta of equity to compute my cost of equity using the CAPM. Risk-free rate, beta, market sorry, equity risk premium. So when I multiply, I get 0.7%. I can now go ahead and calculate my work. My work got to cost of equity, value of equity, value of equity plus debt, plus cost of debt, value of equity plus value of debt. So this is 11.6. Now, value of debt, value of equity is not going to be what? It's going to be ratio given to the ratio given to you. Now, my is 60, equity plus debt is 100. Debt is 1.95. That's after tax. You know, they gave us 3% pre-tax. So you tax on it. 3% bracket 1 minus the tax rate. So I'm having 1.95 times 40 over 100. So when you evaluate that, we have 7.84%. That is what PPT should be using to compute or to evaluate investment project, not 10%. So let me wait for your question in this regard. Question before we move further. My is disturbing me. Okay? Question. If you have one, in the next 2 minutes, I'll give you 2 minutes for you to ask your question. 2 minutes for you to ask your question. 2 minutes. Okay. Which market premium are you referring to? It's given to you in the question now. Look at it here. It's given clearly in the question. This is it. They gave you that in the question right away. We didn't complete it. Any other question, please? Any other question? What happened to the KD in the... Okay, how did I get the KD? I've explained that. I said the 3% they gave us in the question is pre-tax. Take it after tax. 3% into bracket 1 minus tax rate. We give you 1.95. Just convert the pre-tax to post-tax because you need post-tax cost of debt in the computation of your what? In the computation of your work. Do you understand? Is a post-tax that you need, not pre-tax. So just convert that percent pre-tax to post-tax. Whenever you are asked to compute work, must you go through then obviously, Mr. Ahmed Muniru, perhaps you did not start the class with us because I think these are what we first computed. You did not start the class with us. So I think you may need to chat me up privately after this class, please, because it obviously means that you have not gotten the concept of a cost of capital. So kindly chat me up after the class, not this night, please. And of course, it should be even tomorrow evening because I will not be chance during the day tomorrow. But chat me around evening time, around 4, 5, I should be okay. So, any other question, please? Okay, no question. Let us go to the next question. Let's go to the next question. Coming on to confirm the question we are having here. Give me 1 minute, please. 1 minute. All right. Let us take question number 3. Let us take question number 3. Now let's look at the requirement. Let's look at the requirements. You are required as chief accountant to the company to prepare a report for the directors of FCA Limited showing A, whether the investment in the machine is worthwhile, and B, which financing alternative is to be preferred. Which finance alternative is to be preferred. Now, before we take this question, please, if you don't have your jotter, please get one and get your pen. Let me quickly explain the concept to you before we solve the question so that you have a direction. Not about solving question alone. You need to know the procedure you need to follow whenever you want to ask a question, answer a question. You have it. I sent this material since yesterday, sir. This material was sent since yesterday, not even today. So everybody should have it. But let me quickly re-forward it now. But I've sent this since yesterday. So don't say we, just say I did not have it. Okay. So let me go and forward the material again. Let me send it to the group again so that if you don't have it, you can have it now. Okay, that is the material there. That is the material there. I've sent it to the group. Now, whenever you want to evaluate a lease or buy alternative, there are some procedures you need to follow. A lease or buy decision is the decision as to whether it is economically viable or advantageous to buy the machine utilizing a bank loan or using a lease arrangement. That's why it's called a lease or buy decision. Okay? Lease or buy decision. Is it better to the bank to buy machine, or is it better to take the machine based on lease arrangement? Okay. Now, to evaluate a lease or buy decision, there are two broad decisions that you want to make. Before I will think of buying anything at all, that thing, I must be satisfied that the thing is even worth buying in the first place. For instance, this modem I'm using here, before I will buy this modem, I will have look at it at, okay, is it even worthwhile buying this modem in the first place? If it is not worthwhile, if buying the modem is not going to add any additional benefit to me, then Why am I buying it? It means I will not even give myself headache as to how I should finance the acquisition, okay? Since it is not worthwhile to buy initially, so why am I now disturbing myself looking for a way to finance it? I believe you got the logic. But if I have calculated it, I discovered that, oh, it will add more benefit to me if I buy the modem. Then I will say, okay, how do I finance the acquisition of the modem? Okay, now, in essence, what I'm trying to say is that for you to evaluate lease or buy decision, the first thing is that you have to go and evaluate whether it is worthwhile to buy the machine in the first place. So that decision is called the acquisition decision. These are the two decisions. One is what? Acquisition decision. The acquisition decision is where you evaluate whether it is even worthwhile at all to buy that machine. And for you to evaluate that, you use your normal NPV criterion to evaluate whether it is advantageous to buy the machine or not. If you have computed your NPV and your NPV is positive, then it means the acquisition of the machine will add value to shareholders as well. They will now say, how do I purchase it? How do I finance the acquisition? That is what? That is the financing decision. That is the second stage, financing decision. Now, in the financing alternative, you look at the question. Now let us write. Assuming the question has given me two alternatives, lease or what? Or bank loan. Number one that I will do is that I will identify the cash flows that is associated with all these financing alternatives. So when I pick bank loan, I will list out what are the relevant cash flows, what are the cash flows that will come up as a sort of borrowing from the bank in order to finance this machine. I will look at it. Then I will look at what are the cash flow that will arise if I should take this asset based on, then I will evaluate the financing based on those cash flows. Okay, let us look at the first one. The what? Financing through bank loan. Financing by utilizing what? A bank loan. The first relevant cash flow you can think of is the cost of the machine, because if you want to borrow to finance the acquisition of the machine, the amount you want to borrow must be equal to the cost of the machine. That is why we say the cost of the machine is the first relevant cash flow. Okay, after the cost of the machine, what next? Then, for every machine you buy, you are the owner of the machine. Therefore, you can charge capital allowance. It means that capital allowance is a relevant cash flow for what? Financing through bank loan. I believe you are jotting this down. Please write. Number 3 is interest. When you borrow from the bank, you pay interest. So interest is relevant in what? In bank loan. What other cash flow is relevant? Describe value of the machine. Because if you take an asset, you bought an asset, you are what? You depreciate the asset, then the asset should have residual value. Whether zero or with a positive figure, there must be a residual value. Okay? These are the 4 relevant cash flows. You mean I'm too fast with me solving one question for 50 minutes? You say I'm too fast. Okay, no problem. No problem if you say I'm too fast. Okay, so I have identified 4 different cash flows, Abi, for the bank loan, which is what? The cost of the machine. Number 2, the capital allowance that you are going to charge on the machine. Number 3 is interest. And number 4 is car value. Okay, let us now go back to lease. We have two types of leases. We have the operating lease, we have the finance lease. Let us start with finance lease. Finance lease is that lease that transfers the reward and risk of ownership to the lessee, isn't it? So the risk and reward of ownership is transferred to the lessee, means that from the substance of the transaction, the lessee is seen as the owner of the machine. And for any machine that you are the owner, you can what? You can claim capital allowance. Therefore, the relevant cash flow for a finance lease are: number one, lease rental payment. Lease rental payment. You pay lease rental when you take an asset on lease. So the lease rental payment is relevant. Number two is tax saved on lease on interest portion of lease rental. Tax saved on interest portion of lease rental. Okay, what am I saying here? Because finance lease, you are assumed to be the owner of the what? You are assumed to be the owner of the asset. So what you from the point of view of the substance of the transaction, what you are paying is just an amount that will cover the principal repayment of the asset. That is, you are paying back you are paying for the asset by installment, and you are also paying service charge, which is what finance charge. You are paying finance charge. Okay. Now, it is only the finance charge that is an allowable deduction in the income statement. The principal repayment is not an allowable deduction. Therefore, there is need for you to separate from the lease renter. You have to apportion the lease renter into principal repayment and interest payment. And it is only the interest element that will be what? Subject to savings in tax. That is why I said the second relevant cash flow is what? Tax saved or interest element of lease renter. Are we together? Okay. For that same finance lease, because you are seen as the owner of the asset, you can claim what? You can claim capital allowance, you can claim residual value. Now, what you will now do, having identified the cash flows associated with finance, with bank loan, and we have identified cash flows associated with lease. Now, you have to do what we call netting. How do you do your netting? You look at the cash flows that you can find under bank loan, and you can also find the same cash flow under finance lease. You eliminate such cash flow, because the only cash flow that is relevant for decision making is incremental cash flow. Any cash flow that I'm going to consider for my analysis must be an incremental cash flow. I believe we got it. So if I want to go by that, I will say number one, capital allowance is common to both of them. So capital allowance should go. Scale value is common to both of them. Scale value should go. So that will leave me to just two items in where? In the bank loan, isn't it? For the bank loan, I have two cash flows left. Now, what are they? Cost of the machine and interest on what? On the loan. Now, the interest on the loan is not considered as relevant cash flow in the real sense. The reason being that it has been mathematically proven that if you charge interest over the life of a loan, and you discount the absolute amount of the interest using the same discount rate, you are coming back to what? To the cost of the asset. So when you are evaluating bank loan and there is no any other relevant cash flow apart from interest, ignore the interest. Just tell the examiner that the present value of the interest payment on the loan is assumed to be substantially equal to what? The cost of the machine. That is all. Do you understand? Let me see a question in this regard, whether you understood or you do not understand. Let me ask a question in that regard, please, before we proceed. I'm giving you just 1 minute to do that. If you have a challenge understanding that aspect, please chat me. Okay, I believe all is well. I believe all is well. So let us now go to the what? The finance list. For the finance list, we have eliminated what? We have eliminated capital allowance. We have eliminated get the cane. Which one did you not get? Which one did you not get, please? So that I can explain before we continue. Excuse me. Okay. Now, we have eliminated 2 cash flows from finance through bank loan, Abi. You know, we identified 4 cash flows, which are what? Cost of the machine, interest, capital allowance, and what? And scrap value. Now, I said because capital allowance is common to bank loan and finance lease, it should be eliminated. 1, scrap value is common to both bank loan and finance lease, it should be eliminated. Then I'm now having interest and what? And cost of the machine. Now, it has been proven that if you charge interest on a loan, the loan you use to buy an asset, if you charge interest on the loan over the life of the asset and you discount it back using the interest rate, you are going to get the cost of the machine back. Therefore, don't disturb yourself computing interest. Ignore interest completely in any situation, okay? What you just need to do is to take the cost of the asset to represent the present value of the bank loan. That is so. This is what I explained. Okay, let me see. Take this question as well. Okay, I believe I've re-explained that. Thank you. Now, for finance lease, we have also eliminated capital allowance. We have eliminated scrap value. We are now left with what? Lease rental payment and what? Tax saved on interest portion of lease rental. So what will you do? I will take my lease rental payment. I will read, you know, it's a payment. It will be an outflow over each of the years, over the life of the project. Okay. Now, if I treat them as outflow, the amount of savings on my interest portion of the lease rental is going to be treated as an inflow to me. So it's going to reduce the lease rental payment. So I will not get my net cash flow. Then I will discount it using post-tax cost of debt. Please take note. Anytime you are discounting financing alternative, then the cost of capital used is the after-tax cost of borrowing. After-tax cost of borrowing is the rate you are going to use. Is the rate you're going to use. Okay? After doing that, after you have discounted, you now look at which one is the lower. Is it the finance lease that is giving me a lower present value of cost, or is it the bank loan that is giving me the lower PV cost? Which one is giving you the lower is what you are going to recommend that management should choose for the payment for the acquisition of that machine. Okay, so let's go straight and take the question. Required you are required for the vintage whether worldwide financing alternative is to be preferred. Which financing alternative is to be preferred? Okay. The question limit is invest in machine 60,000 naira. Purchase will be the first of the next financial year. The machine is a 5-year life. At the end of which it will have value disposal. The use how the company to lay off immediately one supervisor, currently 10,000 naira per annum, and to use its overhead system at current if we buy this machine, if you buy and buy the machine, we are going to lay off a supervisor. We are going to a supervisor is currently any what? Supervisor is currently any 10,000 per year. The supervisor is currently earning 10,000 naira per year. So if we buy this machine, we are going to lay off that supervisor. And to reduce it over by naira per annum at current prices. Now, current prices means the cash flows there are stated in year 0 prices. Okay, that is real cash flow. They are all real cash flow. Okay, this is to give this. The machine will be of case, right? For this 10,000, if we did not lay off staff, how much would we have been paying for it? We would have been paying 10,000 at the current inflation rate to supervise. So we are going to see if look at it. This is the inflation rate. Okay, inflation rate. So it therefore means that if we did not lay off the supervisor, we'll be paying an inflated rate of 10%, okay? That is 1.05 times 10,000. The next year also 1.05 times 10 is what we will have been paying to the supervisor. We not let him off. But because we have laid him off, we are saving those what? We are saving those amounts. So you need to inflate that 10,000 naira for the next 5 years. That will represent your savings. Okay? That will represent your savings. Then, other overhead. You also need to inflate other overhead for the next 5 years to get the savings in overhead. Okay, let us continue. The company expects to pay salary increase to all its supervisory labor in the future at the annual company rate of 5%, and estimated that it be wise to annual rate of 10%. Can you see that? So we expect salary to be increasing by 5% yearly. So he supervised laid off, his salary will be increasing percent every year. Because we have laid him off, we are saving all those the company finality, he maintained a debt equity ratio, and as part of overall policy, debtors finance the machine that by getting a loan 6 naira effective interest rate of 8% or paying a lien for the life of the machine. Financially, okay. Let me quickly log out. Then I log in again. Let me change network. Let me try another network. Log out. Change and come. So kindly give me 2 to 3 minutes to do that, so I can hear it clearly. Thank you. Okay. Sorry, I needed to quickly log out so that I can hear me clearly. Can you hear me clearly now? And can you see my screen clearly? Can you hear me clearly now? All right, thank you. Thank you, thank you, thank you. Let us continue. Now, the finance alternative that the company is considering is whether to what? Whether to buy using bank loan or whether to take the machine on finance lease arrangement is it finance lease they call it? Okay, let me see. The company expect to pay salary. No, we are past that place. Or obtain a lease. Okay, obtaining a lease. We are not told whether it is a finance lease or an operating lease. Let us continue. For the life of the machine. In this case, the lease payment of 50,000 will be payable annually in arrears. And at the end of lease period, the machine will refer to the lessor. Look at this key. Who can tell me from what I highlighted, from that information I highlighted, how do I classify this list? How do I classify the list from what I highlighted here? How do I classify the list? Yes. Answer me. Okay, from operating list, are you sure? Okay, any other response? If your man says operating list, Ejanusi says operating list. What other? Operating list. Everybody. What about if I give you a contrary opinion? Will you follow it? If I say it is not operating list, will you follow it? All right. I'm not here to confuse you. You got it clearly well. Okay, you got it clearly well. That is an operating list. If it were to be a finance list, then the, what do you call it? The asset will have to revert to who? To the lessee. The lessee will become the owner of the asset at the end of the lease term if it were to be a finance lease. So this is an operating lease. Thank you. You got it clearly correct. The company obtained corporation tax relief of 40% in each first year after the end of the finance year in which they arise, and expect such relief to continue indefinitely. What does that mean? We are saying that tax is paid a year in arrear. That is the information there. A 75% first year allowance is available on this type of machine. Written down allowance available is at a rate of 25%. So in the first year capital allowance is 75%. But after the first year, capital allowance will now be at what? 25%, reducing balance. The company has weighted average cost of capital, net of corporation tax of 15%. Unless stated, you may assume that all cash flows arise on the last day of the year to which they relate. So we are to prepare a report to the directors of FCA Limited showing whether the investment in the machine is worthwhile. Now, how will I get that? That is the acquisition decision, right? A is the acquisition decision. And for the acquisition decision, what do I need to do? I need to look at, if I buy this machine, what are the savings I'm going to get from the machine? Okay, how will it improve my what? My market value? How will it improve my shareholders value? That is what we call the acquisition decision. Okay, now I will go and look at the relevant cash flow. You see that we're told that if we buy the machine, the supervisor will be laid off, so we are going to save the salary we are paying to him. Also, there's going to be reduction in our other overhead to 6,000. So we are going to save from that as well. So that is what we are going to compute first. So look at it. Savings in salaries, savings in other overhead costs. So the savings in salary you are going to recognize is going to be inflated because the one given to us in the question is what? Is real. So I will say for the salary, these are the real cash flow, real salary. I recognize my inflation rate, 1.05 raised to power 1, 1.05 raised to power 2, 1.05 raised to power 3, 1.05 raised to power 4, 1.05 raised to power 5. Use it to multiply 10,000. We got this. These are what we are going to save as a sort of the machine. Okay, and that's what we have up there. Then for the overhead, the same argument. For the overhead, we have the same argument. Excuse me. Okay. For the overhead, look at it. Okay. Where did I put the workings? I think I put the working of this one here. This saving in salary, but savings in overhead. Oh, okay. Sorry. The second one here is not savings in salary, it's savings in other overhead. Please put it there. Change is not salary. Savings in other overhead. Savings in other overhead. Now we are told that other overhead we are going to be saving 60,000, Abi, and the inflation rate is what? 10%. So inflate it at 10%, we got all this. That is what I put there as my what? As my other overhead. So I will save this as a sort of salary. I will save this as a sort of other overhead. Okay. So what will be the total saving? Total savings is going to be this. Now, when you save, it means your profit will increase. And the moment your profit increase, you are going to pay more tax. So I need to charge my tax at what? Charge my tax at 40%. 40% of this tax is paid a year in arrears. 40% of this will give me this. 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 40% of this will give me that. Okay, so this is the net savings. This is the net savings. We are given the cost of capital there, isn't it? So I will now say this capital at 15%. I compute my discount factor, then I get my present value. So present value is negative, meaning that if we buy this machine, we are going to save 42,181. Since it's going to lead to savings, I will conclude that FCA should buy the machine because it will increase shareholders' wealth by 42,181. We are inflating in first year because we are told that the cash flows are stated in real term. In real term means in terms of year 0. Year 0 is the beginning of year 1. And we are assuming that cash flow arises when? At the end of the year. So the cash flow that is arising at the end of year 0 will suffer a complete year inflation because I have to grow it from the beginning of year 1 to the end of year 1. Do you understand? That is the reason. Any cash flow that is stated in terms of year 0 and you have inflation rate, then you have to start growing it from year 1. Okay? You have to start growing it from year 1. That is the reason why we have to grow this from year 1. Okay? Now, have you decided on whether or not it is beneficial to acquire this machine? And we have concluded that it is worthwhile, it is advantageous to buy the machine. Then we now say, how do we now finance the acquisition of this machine? How do we finance the acquisition of the machine? That is the next. Okay, that is B. How do we finance the acquisition of the machine? Okay, excuse me. I jump one thing here. Now, before finance through operating list, excuse me, let me take water. Okay, before, okay, sorry. There's no, it's not a mistake. I think, okay, this is it, okay. This B is correct. I was thinking I jumped this first part of the solution. I didn't jump is there. You are not deducting the cost from the PV because the question has already given you savings. You are not, it's not revenue. It's not revenue. Okay? You don't have revenue, cost of sales, all those things. So you are not computing a complete NPV. Okay? We are looking at the savings. We are looking at the savings. This is the additional savings the acquisition will bring to us. It's different from the normal NPV. If the client says, oh, this is your revenue, this is your cost of sales, this is your relevant fixed cost, then you go and compute your what? You go and compute your NPV. But in this question, you are given the savings. We are going to save in salary. We are going to save on overhead. So you are not deducting cost of the machine. That is the reason why I have not deducted the cost of the machine. Now, for borrowing to buy, what will be the relevant cash flow? Number one is what? There's going to be cost of the machine will be relevant. Okay, cost of the machine will be relevant, and that is what we have here. The relevant cash flow already in the first this thing. Okay. This is one of the relevant cash flow because capital allowance is not available on operating list. It's only on operating list. The substance as the owner of the asset, understand? So capital allowance in this situation here is relevant to only the bank loan, but not to operating list. Okay, so I'll go and compute that capital allowance. Capital allowance, yes, 60%. Now you sorry about the network, please. Now, the first allowance I'm going to charge, we're told is going to be 75 75%. 75% of 60,000 is 45,000. So tax is paid a year in arrears. Pay that tax in year one. Okay, this is the tax within that value. 25% of that is this. Tax saved at 40% will give us this, and it's going to be charged in year what? In year two. The same thing in year two. This is the tax within that value. It's a year three cash flow. Then the same thing in year. This is the tax within that value. This is the capital allowance. This is the tax saved. That's note 4. Sorry, year 4. Okay, so after it's going to be relevant as well. Okay, sorry, I quickly change my network because the other one is I can see fumbling again, so I have to change to another network. All right. Now, can you hear me clearly? And can you see my screen? Can you see my screen and can you hear me clearly, please? Okay. Okay. Let us continue. Now, scrap value is relevant, and that's why you see scrap value here. Don't forget, I told you, you should always ignore that interest. Abi, ignore the interest. So I'm not going to have tax saved on interest. No. I'm not going to have tax saved on interest. I'm going to have tax saved on capital allowance, my scrap value, cost of the machine. Okay? And I've told you the reason. So cost of the machine will now be in year 0. That is when we are buying the machine. Now, scrap value will come at the end of the year. Now, these are the tax saved on capital allowance from year 1, year 2, year 3, and year what? And year 4. This gives us our net cash flow. Net cash flow. Discount factor. Okay, the discount rate, let me go and show you. The discount factor is not 50%, please. 50% is the WACC. The WACC is what I'm going to use to what? To compute the NPV. That's how we use WACC here. But for financing, you cannot use WACC, okay? You cannot use WACC for financing. This is what to use 8%. Where do we have it? Okay? This 8%, look at it. A loan of 60,000 naira at an effective tax interest rate. Look at it. Tax interest rate, meaning that it is after tax. That's the English there. Tax interest rate, meaning that the 8% is a what? Is after tax. Anytime you want to discount cash flow or financing, whether it is bank loan or it is lease, you should use after tax cost of borrowing. I think I've made myself clear. Don't use WACC. Use after tax cost of borrowing to discount the cash flow associated with the method of financing, whether bank loan, whether operating lease, whether finance lease. You are using after tax cost of what? Cost of borrowing. So that is what we have here. So this is going to be discount factor at 8%. These are the discount factors. So present value will now be this. What will now be the NPV? NPV is 36,224. You can see that the scrap value and the capital allowance, tax saved on them, on the capital allowance, has reduced the cost of the machine to what? 36,288. So I will also go and look at finance through operating lease. What will be the cash flow? The relevant cash flow will be annual lease rental payment and tax saved on annual lease rental. These are the two relevant cash flows for finance through operating lease. Now, because you are not the owner of the asset, if it is operating lease, you are not seen as the owner of the asset. Therefore, the whole amount of the lease rental payment is charged to profit or loss as a finance charge. You understand? It's charged to profit or loss as a finance charge. So that is what? That is our lease renter is what? 15,000 for 5 years. Abi? For 5 years. And our tax savings is 6,000, that's 15,000 times 40%. That's 6,000. And it's going to occur a year in arrear. So it will start from year 2 and end in year 6. Okay, it will start from year 2 and end in year 6. That is why you see this. I'm using annuity, constant annuity, because if you look at it, my lease rental is constant, my tax savings on lease rental is also what? Is also constant. So I will say year 1 to 5, we have the cash flow, annual lease rental, 15,000. Discount factor at 8%, 3.993. This is what? This is the present value. Because this is a payment, lease renter, you are paying the lease renter, then this is the present value of the amount you are going to pay. Then what about the savings? As you are paying it, your tax is reducing. I'm enjoying 6,000 reduction in the amount of tax I'm going to pay, because the lease renter is going to reduce my taxable profit, and consequently a reduction in my tax. So I will save the tax from year 2 to 6, because tax is paid a year in arrear. So discount factor at 3.967. I believe you know how to compute that. You are going to compute discount factor of year 1 to 5, then you deduct discount factor of year 1. That will give you discount factor of year 2 to 6. Okay, discount factor of year 1 to 6, you compute it, then you go and compute discount factor of year 1. Deduct discount factor of year 1 from discount factor of year 1 to 6. The balance is discount factor year 2 to 6. That's how we have our 3.967. And when you multiply by this, we have 23,802. So if we finance through operating lease, this is the amount of NPV. Of course, 36,000 is 093. If we finance using bank loan, is 36,224. So which one is better? I will conclude that because the PV of cost of financing through bank loan is higher than the PV of financing through operating lease, then it is better to finance the acquisition of the machine through what? Through operating lease, because that will reduce our cost of financing. So that is how to evaluate our lease or buy decision. Okay, let me take your question, ladies and gentlemen. We are not going to go further than this for today. Let me take your question in some couple of minutes. I will call it a day. We meet on Monday by the grace of God, the same time, 7 to 9. We meet 7 to 9 by the grace of God for session 3, of our discussion. So let me take your question before we call it a day on this platform. Question, please. This is know the difference between Ifeoma, Know the difference between operating lease. That was the first decision I made. That there is decision between operating lease and finance lease. If you are dealing with operating lease, the whole lease renter is charged to profit. There is nothing like tax save on interest project. There is no interest on operating lease. It is finance lease that has interest and principal. For operating lease, the whole of the lease renter is charged to profit or loss. You don't divide it into interest and the what and principal. But if it is finance lease, then you have to what? You have to apportion it. Okay, so that's the reason why we did not do interest tax saved on interest portion of lease rental. Which first steps are you talking about? Which first step? Did I give you any first steps? I doubt it. Now, Penelope Abi, sorry, I couldn't pronounce your name correctly. You said the tax save the arrears should be year 2, 3, and 4. What happened to the many years? The one for year 1 will come in year 2. One for year 2 will come in year 3. The one for year 3 will come in year 4. The one for year 4 will come in year 5. The one for year 5 will come in year 6. That's what is called arrears. Do you want to ignore the one for year 4? And do you want to ignore the one for year 5? No. You have to recognize them in arrears. That is the arrears there. Okay, that's the arrears there. So it's not going to be year 2, 3, and 4. No, no. It's not year 2, 3, and 4. You have to recognize it. The one for this year will be paid next. The one for next, they will be paid in the upper, and so on and so forth. That is the arrears we are talking about. Yes. Is it not cheaper? Which one is cheaper? Look at it. Finance through what do you call it? Bank loan. If you want to finance through bank loan, our PV, of course, is 36,000. That is what we're going to spend. If you finance through operating lease, you are spending 36,093. Which one is better? Will you prefer to spend more? We are dealing with cost here, not benefit. You are taking the one that has the lower cost. We are not dealing with benefit here. Everything is cost. That is how I see that they are in bracket. So it's better that I spend less. That is why I said we should finance it using what? Using operating lease, because it will result in a lower amount of payment of 36,093. But if you choose the finance through bank loan, you are going to spend 36,224. So which one will you prefer? Will you want to spend more or you want to spend less? So Abimbola Adejumoke, I've answered your question. It's because you are dealing with cost. That is why I choose the lower of the 2% value of cost. I mean year 2, 3, 4, and 5 only. While taking it to year 6. The one for year 5, where are you going to pay it? Are we together? Penelope, the one for year 5, where are you going to pay it? Are you going to ignore it? No. You have to pay that in year 6. So that is it. Are you, hello, Penemola? I don't understand you. Are you trying to say what I did there is not correct, or you are seeking clarification? Let me get your point first. Are you saying what we did is not correct, or you are seeking clarification? Because your question seems authoritative. You say I meant the annuity factor should be from year 2 and 5 only, and not 2 to 6. Are you saying we are not right, or you are seeking clarification? before I know how to respond to your question. Okay? Okay, Abimbola, I thought the list with 36093 is operating list. Yes, now it's operating list. And the second one is what? Bank loan. Which one is lower? Okay, but that your statement does not show you are thinking. You are saying it as if that is how it should be. Okay, look at it. I've said it here. Look at what we did here. Let me go to where we have that. You are paying this lease for how many years? For 5 years. Year 1 to 5, 1, Abi? Isn't it? Okay. The, what do you call it? The tax saved on lease renter will start in year 2. It will start in year 2 and last for how many years? If you are paying this one for how many years? It means this tax will also occur for how many years? For 5 years. But that's not until when? Until year 2, because tax is paid in arrears. Okay, tax is paid in arrears, so the tax will not come up until second year, and it will now come up year 2 1, year 3 2, year 4 3, year 5 4, and year 6 5, because you cannot throw away any of the taxes. If you are saying it should be from year 2 to 5, the tax you are gaining in year 5, are you throwing it away? No. So the discount factor is not going to be the discount factor of year 2 to 5, because the tax is what? From year 2 to 5. That is the principle. That is the principle. So you now do annuity factor year 1 to 6 and deduct annuity factor of what? Of year 1. The balance is annuity factor year 2 to 6. Any other question, please? You are welcome, Penelope. You are welcome. Any other question, please? Is that not my decision? That's what I said now. Finance, okay, operating, oh, okay, this is what I'm saying. Okay, just a typographical error. Just put finance there now. We did not evaluate finance list now, you understand? So just put operating there. Okay? Just put operating there. It's a typographical error. I didn't know that's what I'm trying to point out. Okay? That's a typographical error. So change it to operating list. Finance through operating list is marginally better. So it should be what? It should be chosen. Okay? I believe it is clear, Nabi. It is clear. Any other question, please? Any other question? Any other question? Okay. In the absence of question, okay, you have one. Okay, you're welcome, Informer Form. You're welcome. I'm confused about the DCF. What I have is 3.697. For which one? Is this for year? What you have is what? Let me see. What do you say you have? You have 3.697. 3.697. Oh, let me see whether it is interpolation error. It might be interpolation error anyway. Let me confirm, please. It might be error of interpolation. Let me confirm what you said. 1 minus 1 minus, what happened? My calculator has gone mad. Please, a minute, please. Okay, 1 minus 1.08 raised to power minus 6 divided by 0.08. That's a 4.62623. 1.08 raised to power minus 1 minus 4.623. Oh, okay. Please, is interpolation error. Okay, it's an interpolation error. It should be 3.697. Okay, it should be 3.697. That's interpolation error, please. 3.697 times 6,000. 22,182. This should be 22,182. 22,182. Thank you. So you can just correct that. It should be 3.967. Sorry, 697, not 967. Thank you. Yeah, you are correct. Informer, you are correct. It's interpolation. Any other question? Okay. Thank you for staying with me once again on this platform. I want to believe we had the next time. I want to believe we are taking the pain to. No. Are you sure the decision cannot change? The present value is going to reduce further because currently it's what? 802, and it's going to be 182 or 18 something. It's going to be 22, 182. So you assume this one will reduce further. You understand? Abi, will it reduce further? Oh, okay. It's going to increase. Okay, you are correct. Because this one is not going to be lower. So this one will increase. So I think the decision is going to change. You do the computation and see whether what we now have here will be higher than that of the bank loan. If it is higher than that of the bank loan, then the decision will definitely change. Okay. So we are meeting on Monday by the grace of God, by the special grace of God, 7 to 9 for session 3 of our discussion. Till then, do have a wonderful night rest. Bye. My host.